Joining me now, Fox Business contributor Lou Basenese. You still are bullish on energy. You love XLE, you own it,
yes.
And you say that we should not be walking away from the energy
No, because
trade.
last year I was banging the table on this and no one would listen. It was the most unloved, hated trade in the market. Hedge funds were the most bearish they'd been. But if you look, we're still early days in this trade. I mean, all these higher prices, the oil companies have said they're not going to expand production. That means all the higher prices and the extra profits they get from that are going to drop to the bottom line and boost earnings. And we know earnings always drive stock prices. So XLE, the energy sector, is up about 36% already this year. The next closest sector is only up about 6%. But I liken it to tech, right? If you gave up on tech after it was up 36%, you would have missed 3 more years of a bull market in the tech sector back in 2022 when it kicked off. So I think this has staying power for at least 2026 because this is not something that quickly corrects itself.
Well, but what do you say to investors who, I mean, would you buy into energy now? Because certainly everything is inflated because of the conflict. But President Trump has been assuring the market for the last 4 weeks that this will be a short-term conflict. What happens if those stocks all start to fall?
So I don't think they will, because here's why. They were so cheap. If you look last year, they were trading at about 13 times, 14 times forward earnings, the cheapest sector in the S&P 500. Now, fast forward, they're only up to 19 times. So you're still in line with the broad market. I think you could get the valuations that are another 20 to 30% higher from here just on them benefiting from, call it, another 2 to 3 months of higher than expected oil prices.
You still are bullish on tech, in particular software, which is certainly an interesting component. But in general, we have seen, obviously, there's been a pullback on Meta this week because of what happened with the social media trial, et cetera. But just in general, how do you feel about the sector overall?
I love tech still, but I think you have to change, and you got to focus on platforms over personalities, right? So I'm not a big fan of Tesla, that personality of Elon Musk, or a Mark Zuckerberg at Meta. I think you got to move over to the Apples and the Alphabets of the world that can really expand their products. They have multi-product lines that can generate revenue. The tech sector on its own, like you said, has come back significantly in terms of valuation. So, you know, we're not having that argument anymore. Is tech too big of the market driver? The weight and the valuations are down to like 22, 23 times earnings.
Yeah, you say in your notes, Meta just blew up the jobs apocalypse theory.
Yeah.
What did you mean by that?
Well, look, because I think Meta is now hiring more people. They're going to get into it. Like they overspent on AI. But here's what we're seeing. Ironically, the more that we use AI, the more we need software engineers to manage those projects. Alibaba had a great study out that showed they tried to give coding over to AI, and in 8 months, 75% of the projects that AI tried to run on its own failed. So you need human oversight, you need human intervention, and if you look at job postings for software engineers, they're actually going higher now, not lower. So.
Hence the software play in general and software companies, which has been highly debated because of AI writing software programs, and there's probably going to be some winners and losers. I know that I've heard you say that before. Real quick, before we go, just talk to me about your general market sentiment right now, because we're facing some issues. We're going to see some higher inflation reads coming out in the next reports of CPI and PPI. The jobs report for March is coming out. Retail sales is coming out. As you look forward now, what do you see?
Yeah, so I'm still optimistic, and here's why. I said it earlier, earnings ultimately drive share prices. If you look at S&P 500 earnings growth, they've been double digits for 5 quarters. And then more importantly, profit margins are now 13%. So that's a buffer. If inflation starts to tick higher, we get a little bit of a drag on the economy, GDP growth slows down, you have that built-in buffer where companies aren't teetering on the brink of unprofitability. They've got room to absorb it, paying higher wages if they need to combat inflation for employees. So I'm generally very optimistic about the future potential, especially in the back half of the year. We're going to get the president's pro-business, pro-tax reform policies really kicking in. So for me, it's about how long does this last, this conflict and war in Iran last, because it starts pushing up against the midterms. If interest rates stay higher, that impacts real estate. But I don't invest based upon fear. I'm basing it on the fundamentals, and the fundamentals still look really strong for individual companies.
Lou, it's great to see you as always.
Always good to be here.